Hello, everyone. Welcome back to Indiacharts, a new episode of Decoding Market in 3 Moves, a power packed session where we strip away the noise and get straight to what matters in the markets. In today's fast moving world, trading isn't it just about knowing what to do, but when to do it. And that's exactly what we are here to decode. We are joined by none other than Mr. Rohit Srivastav, who will walk us through 3 key moves to navigate through the current market scenario with clarity and confidence. So let's dive and unlock the edge like the smart traders, right? So, welcome back, sir. Welcome back to the new episode.
Pleasure being back.
So, there has been too much ups and downs in the global market, right? So, what's your take on that?
We've sort of weathered it. In fact, we had, if we look back a year, India has actually moved on its own. It topped out first. It was falling when US was going up. Then it started bottoming out first. Even when US was crashing, all we did is we made a double bottom between the first week of March and first week of April. And let's see. Right now, US markets have been stretching a lot. I don't know where. Somewhere they also need to pause a little bit. Indian markets attempted to take off last week. We have paused this week so far, but we are still to see the real takeoff over here. People are still not feeling it. That's the difference. So world markets just give you a sense of, okay, as long as there is no crisis, we can follow our market on its own without worrying about anything. The only time world markets take center stage is when there is a major crisis. And this time around, all the three crises of the last 3 months have become discounted in one day. And we've discussed that in so much detail that markets discounting mechanism is very, very fast now because of news flow. And because of the advance announcement of certain news items that in advance tariffs are coming. Okay, they were bigger than expected, but it lasted for a day. And the same thing with, whatever news we've had on the war front. I mean, the day they announced the attacks on Iran, that was a low point for Nifty. So, so I think we have to just get prepared for these things getting discounted in what is a very strong and liquidity-driven market. And news flow in the modern day and age travels around very fast, so people react immediately.
So then, given the recent escalations, in the Middle East and its impact on crude prices, right? What levels or indicators should Indian investors watch to manage risk in sectors like energy and auto?
Well, the oil price itself, if it's not going to go past, what was that, 78 this time was the trend line breakout of all the highs of oil over the last 6 months, and we failed right there. Now, as long as you're below that, it's not really affecting much. But when you talk about Indian investors, we have to remember that oil prices in India have been kept stable. It's almost being it's almost like you've converted the oil marketing companies into the oil pool account. People don't know what is the oil pool account. Well, prior to the 2000s, we used to have an oil pool account, which was a government-run below the line accounting, as we call it. Basically, it was a fund where if we ended up importing too much oil at high prices, that loss was taken into that account. And if oil prices fell a lot and there was a gain, that gain was taken into that account. So the profit and loss from a higher or lower oil price was at a certain price was absorbed by the government over time by debiting and crediting it to that account. So it was called the oil pool. Now, if oil prices stay too high for too long, it would end up becoming a loss for the government. But it was usually accounted, what we say, below the line, so it was not counted in the fiscal deficit numbers. Now, after deregulation, the oil pool is not there anymore, and now oil prices are changed from time to time. And thus the profit or loss from oil price action ends up going to the oil marketing companies. But here's the thing, over the last couple of years, we have really not been changing oil price. So when oil prices were high, yes, the OMCs took a slight hit. But when oil prices are down, all the benefits of lower prices is going directly to the OMC. So they benefit. Okay, so they end up acting as the oil pool indirectly. And the only thing the government does, it ends up putting some kind of tax, which actually makes it more difficult for oil prices to come down. So oil prices therefore have been fixed. They're at the same level for like 2 years now or more. I haven't even checked. Sometimes they might just move it by a rupee or two up and down, but apart from that, they've kept it fixed as long as there is no exorbitant runaway move in oil prices. Oil prices at the street level for the consumer in India are not changing, and therefore it doesn't impact autos or consumption.
Got it, sir. So, going forward, the FII flows have turned cautious with global uncertainty rising. Do you see this as a temporary sentiment shock or a sign of deeper risk of
No,
for
the exact,
emerging markets in India? Like,
unfortunately, it's the exact opposite, because when we talk of positioning, long short, and people go to strike, okay, and we look at the positioning, so I can actually use the strike data points. Let me just share it. Okay. So most people believe that FIs are the smartest people in the room. I believe they are, but that doesn't mean that their positioning has anything to do with it. Their positioning is consistently a reflection of their sentiment, hedging, to what extent they're hedging their portfolio or whatever they may be doing. In the process, what ends up happening is that when they're actually fearful, as you are saying, they end up having the biggest short position on book, and that ends up often being the bottom in the market. So at these red lines which I'm drawing right now, okay, and I'm circling it on Nifty so that people can see what really happens down here when they're short by more than 100,000 contracts. This was the largest on book recently. Okay, it's never happened before, so we can call that an all-time high. It was associated with this period. But even this little touchdown to the red line, which happened after here before on the Trump trade, is exactly here. And then this is what happened recently on the wars, on the Iran thing. It was already, they were adding shots before that, and then when the Iran thing happened, you're still down here. And now this, what is important then is what has happened on expiry. Okay, on this expiry, 3 days ago, FIs left their shorts, a large amount of them. Now they're left with only so much, but they're still short. So in other words, I would say the negativity is still not gone, which is actually what will propel this higher from here. See, so you have more short covering available for the market to go higher. So when you're studying this position data, you have to actually think about it very, very differently. You have to look for it to be a indication of a potential trend reversal or a continuation, but the exact opposite of the positioning. On the other hand, in fact, if people go and look at domestic institutions, they are holding record long positions, near record. I mean, this was, of course, the record, but here at the red line and still within this range, they are not giving up their longs. Even on expiry, they did not give up their longs over here. Okay. So this is the super bullish indication, and we all know they are sitting on a lot of cash to be deployed. The only worry that people are having is, okay, are the valuations too high to deploy? But they're deploying slowly. But the entire thing is they're supportive of the market. So this is what has really been happening.
okay, sir, got it. So, moving to the next question, US bond yields are falling as Trump is planning to bring in Dove at the Fed. Okay, is worst behind us as far as the US bond market is concerned?
It it definitely would look like that, because the fear that was being created in the market was that there's a lot of US bonds to roll over, and that will cause a bond collapse and things like that. But if that was true, the bond prices would not be rising; they would be falling. However, bond prices are rising, bond yields are coming down, and they are partly to do with what you mentioned, that they are looking at installing a dove at the Fed. A dove meaning somebody who is bearish on interest rates, somebody who's going to cut interest rates. So he's searching for a name. He may announce it well in advance if he wants to keep the market stimulated. And the very announcement of someone who is more dovish than Jeremy Powell, is going to keep bond yields coming down. So that pressure point is, I don't think, going to be there, even though they've sort of done away with quantitative tightening altogether, 25 billion left on the table. Yeah, it looks like, see, they nobody's going to let their own bond market fall apart, especially government bonds. So they will find a way to solve it. It was just a near term risk that we were all watching. What if there's one sell off in bonds just out of the fear factor? But doesn't seem to be happening. It happened a little bit, let's say, because we did see yields go up last year between, say, December and in fact September and I think Feb, or Jan rather. After Jan, bond yields started to come down again, and then sort of that entire move came to an end. So yeah, I don't think we are seeing another bond market calamity.
So this brings us to the last question of today. So markets are going up on a very little participation, right? Is that true? Is that a bad omen along the poor numbers in GST or advanced tax?
So couple of things to unwind here. One is, of course, how the market's discounting mechanism is of the current and the future. And before we go to that, let us just go back to strike and look at some breadth indicators to understand this, because I know it feels like that. Even I feel like that sometimes. There is the stocks, half the stocks I'm trying to buy, I don't move. PSUs are stuck. So is anything happening? At the same time, we have gotten used to the idea of rotation. So sometime back, real estate stocks are the best performing stocks. Well, now they've been going down for 2 weeks, but then something else is going up. Metals are up today. So either we believe that rotation drives the entire move upwards, one sector at a time. Therefore, eventually every sector will participate at their own mood. And in that way, then we can't worry about each sector. So therefore, look at breadth indicators. You see, throughout this rally, if stocks were not going up, your advanced decline ratios would not be positive. Right now, people may say, oh no, advanced decline is just a particular day, more stocks went up than down, but most stocks are still down. Now, again, that's a fair argument to have. And therefore, instead of breadth, what we end up looking is at some, say, diffusion indicators like this. And I'll go to the broadest one. Let's say number of stocks above or below the 200-day average. Okay, and let's take the entire total Nifty market. So all Nifty listed stocks. If most stocks are falling, then why is this indicator up? This indicator shows how many stocks are above the 200-day average in percentage terms. At the bottom, that number was down to almost 12%. In fact, the lowest was, I think, a single digit, 9% over here. And from 9% today, the number is 55%. So a lot of stocks have gone up. We'll say, no, market is up, but stocks are down. That would be true if you saw something like this. So here, when the market was going up to new highs in September, then this number was actually coming down. So fewer stocks were participating on the way up. It was true. And that divergence eventually led to a bigger fall. Okay. And now if we compare these two lows, you actually see a positive trend here to here also. So therefore, I think slowly and steadily, yes, I agree. At 55% means there's still a lot of stocks which are not above. So you haven't got the whole market moving yet. But from 0 to 55, we have advanced. And just because it's 55 and doesn't feel like it, doesn't mean it can't go to 80 tomorrow. So somewhere I have to believe that, from such an extreme oversold territory, which was down here, we are likely to head much higher. Now there could be a midway stopping point, of course. That is something fair to expect sometimes. Like here, it stopped for a while, came back, then went up. So will this pull back at some point of time? For that, but we actually go back to looking at the wave structure of this and try to decide whether the trend should change. So far, I'm not able to judge that there is any trend change. But so one point I've taken care of, that it's wrong to assess that stocks are not going up just because rotation is happening and some sectors have not yet started to participate in the move. Secondly, the reason for that can be somewhat fundamental. The reasons you mentioned, GST collections and advanced tax, are indicative that the economy is still not on full steam, and that is partly why the RBI went ahead with a 50 basis points rate cut. Now, the market's discounting mechanism is like this. It falls first and then bad news comes. Bad news comes afterwards. So it fell in March, April. The bad news is coming today. But now on that bad news, I cannot discount. I cannot go back to the April lows. It doesn't work like that. And
It's already
similarly,
discounted.
today the market will start anticipating what these rate cuts, liquidity, etc., are going to mean 6 months down the line. So, are we going to get a great result season? Answer is no. Does that mean the market is going to crash? The answer is also no. You will get stock specific volatility. Some stocks may fall more because they are not performing at all, while others that are still doing well or just steady in their performance might still be okay. And those which are expected to do well in 6 months will give a bad result, go down 5%, you will sell everything, and then it will go up 20%. So you have to be very, very careful of these kind of traps, because these are the traps in which smart investors buy the bad news, which is bad results, keeping in mind that 6 months down the line, things will be better. So you really have to have that perspective.
What's like a long-term perspective, which will lead us the path, something like that.
Yeah, the bigger idea of where you're headed, both in terms of interest rates and growth, is this the worst that we are going through? If so, then if it can't get worse, then how can you expect lower prices? You're already down. Tata Motors is not at a 52-week high. So if we can talk about car sales now. Those are European car sales. Okay, then let's talk
Yes,
about Maruti then.
the highest one in India.
But it's
Okay.
also not at an all-time high. And maybe close, but still, if you look at strike valuation charts, you might find valuations have come down. So anyway, those are all things to think about. The real question is, where will you be 6 months from now?
Right. So then let's wrap it up for today and let's move to the questions that people are asking. So the first question is from Inatul Bhatia.
Yeah, I don't know if that's the bad news or the good news, because if there isn't much fire, then it means you're still able to get stocks at lower prices. But at the same time, metal stocks in India have actually done better than metal stocks in the US, mainly because of the currency movement. So USD/INR going up to some extent supported commodity prices in India, and to that extent, commodity stocks held out better. They may not have been running away, but commodity stocks are not running away anywhere in the world, and copper is not at an all-time high. So it's just that right now the trend is getting set that okay, the dollar is falling, but commodity prices are not picking up in a big way because demand itself at a global level has not taken off. Right, or everything is moving right now on liquidity, but China is still trying to stimulate. We still to see its growth numbers. Europe also is spending on a lot of things, and so is India. But India is in a good position in terms of demand, which is why you see steel stocks doing well today. So it's not that they're not participating. In both Disco and Sale up more than 3% today, in case nobody noticed. But maybe the other players, copper, aluminium, are not. But there are times when the copper, aluminum stocks do better, and then the steel stocks lie dead. That's again a rotation that keeps going on. So I think they'll do slowly and steadily do well. I am waiting for that momentum to gather steam. When the dollar falls, yes, you should get more parabolic moves, but I think it may happen only after maybe Trump announces the so-called dovish Fed governor who will come in next. That will be the next trigger point for that whole story. But we are pretty close to that trigger point. I mean, you can look at some of the underlying prices, aluminium, nickel. I tried writing about them. Some of them have started to pick up, but they are far, far lower than the all-time high compared to copper. So copper is the only commodity which has actually held up. The others have not held up that well.
So next is the defense.
See, on defense, a sector that has been doing well through the entire previous phase would somewhere continue to do well. It may appear expensive, but that's just how a bull market unfolds. The sectors that drive the bull market continue to be the drivers throughout the bull market, and this bull market's not over. Then the sector will continue to be among the favorites from time to time. So that's as simple as I can make it. Now, if his question is very short term, I don't have a short term view on the sector, but that's just the big picture view on how it is.
The next is from Vimal Prakash.
Why sometimes Nifty spot is at a premium to Nifty future? As today's spot is this and future is this. Oh, I didn't even notice. But you are saying, I thought you said future is below spot. Future is always at a premium. So, but what he's saying, spot is 454 and future is 539. So future is at a premium. Spot is not at a premium in his example. So I'm not sure, but sometimes, see, during COVID, when we were rising from the lows, the future was at a discount. So when you say, you don't say the spot is at a premium, we say that the future is at a discount. So futures are at a discount when there is a short position in the market. Okay, and for months, almost 6 or 12 months of that rally, the Nifty futures were at a discount. So there were shorts, and that was driving most of the move. Now, if it happens, it doesn't happen for long. I've seen it on some days suddenly show up for a day or two, but it is indicative of basically short positioning if it happens. We aren't seeing prolonged periods of discount like we used to before. But yeah, whenever you do, it means people are short.
So moving to the last question.
Which is bullish, by the way. Shorts are, if there's a short in Nifty futures and it's a discount, then it's a bullish view.
So Raghav has the next question.
So the dollar historically is inversely correlated to commodities, precious metals, and so on. It has long-term effects on emerging markets and emerging market bonds, basically, because a lot of the bond financing gets affected when the dollar goes up a lot. Bond yields start rising, and then that becomes an issue. So it has a very indirect inverse correlation, even with Indian markets. Like, which is why if you look at the USD INR, it will typically be going opposite ways. Like USD INR is usually going up when the market is falling and going down when the market is rising. So USD INR is basically USD in front. So that is the dollar. So you will see an inverse correlation between our own currency pair and the Nifty over time. Directly with the dollar index, on long periods of time, you will see the same inverse relation. In short periods, sometimes they will break away. So you can't always. So in a bull market, sometimes you may see even the dollar and Nifty rising together, but eventually there will be a correction, and then everything goes back to the inverse correlation. So that's just what's been the observation, at least for the last 25 years.
So we got a very good question from Janos.
How to find stocks for the long term or positional using strike? So if it's positional trades, you would probably let me share my screen, and hopefully this is our last question.
Yes, sir.
So for positional trades, one thing that you can do is choose a basket, okay, on which you want to trade. So let's just presume it's the FNO basket. And if I want to go long, okay, and positional means that I have a holding period of probably a month plus or minus, then what I would do is I would look for stocks on the weekly chart which are already bullish, which means that are either in buy mode or a new buy mode, which means they're already bullish on the RMI indicator. And then on the daily chart, I would look for new buy signals. Okay, now there may be none like today. If I want to see were there any yesterday, I can choose last candle close, and it's possible there were none yesterday. But this is an unusual period, but many times you do come up with one or two ideas showing up here. But essentially, this is the filtration for looking for ideas as far as positional trades are concerned. Now, this is of course FNO. I can take the basket out and go to Nifty 500 since we are mostly thinking bullish. Okay, it's on. So we actually not getting anything. Okay, there's nothing today. I don't need to go all market out. But okay, let us try going live. Yeah, see, now if I go live on Nifty 500, there are some. So it's a very large basket. So essentially, the ones you would consider are going to be these. I'm saying consider because while there are new buy signals, you have to also read what the RMI and trade setup are doing here. which are the valid ones or better ones, what is the risk reward, and all those are the subsequent questions. But this is sort of the scan that you will use to get started. And so it really narrows down your search. Even from 500 stocks, it's only so much. On certain days, if you only got the FNO basket, you'll have a smaller list as well. You might just get one or two. On some days, you might get a lot. It completely depends. But yeah, that's what you will do for positional. If you're thinking long term, there are 2-3 different ways you can go about this. We will be coming up with some fundamental scanners that will help you a lot. Like one of the things we do is we say, okay, look for stocks that are on the strike valuation setup. Okay, and that means stocks that are getting to the bottom end of the valuation chart. I don't know which stock I should look at over here. Since we spoke about this, okay, so if I actually go and look at, there is some data issue happening here. But yeah, if I look at the historical, let me go to this one. Okay, so here, and I'll have to wait. So here, when I'm looking at something like this and really long term, okay, this is a 1 year data. I often like to go to a max, like look at the entire time horizon. So here, when I'm looking at 10 years of chart, what I'm looking for is stocks where valuations have dropped at or maybe significantly below the midpoint, maybe even to a -1 standard deviation. These are all standard deviation lines, or 2 standard deviations. Now, here I'll have to individually go to each stock and find, okay, has that happened here? Has that happened here? Among the basket that I'm looking for. I can also scan certain stocks technically based on the technical scanners, and then see whether their fundamentals match up. So that would be a techno fundamental approach. We are working on a fundamental scans which will come out in the next month. Then even combination scans which will allow you to put 2 and 2 together. So say for example, you want to know all the stocks which are at a valuation of -1 to 2 on EV by EBITDA, and maybe in a particular sector, you should be able to just choose those parameters and get results within a second. So that is what you would do on strike right now. You may use a technical scan to get there, since we haven't added the fundamental scan. So you can look for stocks which are trending, say above the average, or that have given buy signals, and then check their buy signals on a monthly, not even weekly. Because you're investing. So do a weekly, monthly kind of combination. Look for a weekly buy with a monthly, weekly new buy with a monthly buy, and then see whether their fundamentals add up based on the valuations. So valuations are a very good starting point, because it's much like looking at the sentiment from a fundamental angle. Because when valuations are down, it's a sentiment indicator that people are not expecting great results, or that people are extremely bearish on the stock. It's a very indirect way of having a sentiment indicator, and for the long term. So when people are extremely bearish, definitely you want to be positive, but match that with the on the strike valuation setup I just showed. You also have the RMI, so match it with the RMI, that you're getting a buy signal along with low valuation. You're not just buying something because the valuation is down, but also because the momentum is picking up. So that way you don't end up buying it on the way down and ride it all the way down. That's not the point. Because something which is undervalued can keep falling for bad news. So you have to also put momentum and price together to really get the end result. So this is another step. There are more. There are type of scans that we discuss in the mentorship program, and that allow you to really find trending stocks. And it's there in Strike how to do that. We discuss it in a separate session on Strike, or if you're wanting to join a very comprehensive program on everything beyond Strike also, including Elliott wave analysis combined with fundamentals, something like that, which is where your probability of success can really shoot up, then consider the mentorship program. Join. We have another batch in September, October, and just call up our Indiacharts numbers and check out their offers on that. Sales pitch.
It will be a it will be a life-changing thing for them. Really, because people are there who are using it. So it's from the real life experience that people are telling, sir. It's not a sales pitch, but yeah, It's a
No, I
life
say
changing
this
pitch.
because no, I say this because people may not realize that it's one thing for me to just show a feature here in 15 minutes, which we can, but our live sessions on the mentorship program go on for almost 4 months, 3 hours every Sunday. You have to really give time. If you think you want to learn something, it can't be done on one Saturday morning 2 hour seminar.
Right.
Okay, so we don't do those seminars. We only do, our program is only 3 to 4 months, every Sunday, 3 hours. If you're willing to put in the work, then that's what it's meant for. If you want a quick fix solution, uh, Strike has many things which we've tried to speed up in terms of quick fix, but you need to learn those as well. So of course there are a whole lot of YouTube videos and help videos to understand Strike. But if you know once you know the process, okay, this is what I want to look for. Strike does it in seconds. That is the advantage. But if you don't know what to look for, what should I search, कौन सा parameter देखना है, कौन सा technical search करना चाहिए, then it goes really down to basics, and then you need basic grounding. So basic grounding के लिए you need to go through a program.
Great. So let's wrap up, sir, for today.
Yeah.
So thank you everyone for joining. Stay tuned for our next session on Friday, same time. Thank you.
Thank you.